So, when a company wants to build, say, a brand new factory or launch a cool new product, it needs cash. A lot of it. But where does that money come from? Do they borrow it from a bank? Or do they sell off a little piece of the company itself? This is one of the most fundamental questions in all of business, a genuine puzzle that we're going to unpack today.
And hey, don't just take my word for it. This quote from Stuart Myers' huge 1984 paper frames our whole investigation perfectly. You see, despite all the incredibly complex models and theories out there, the real-world choices companies make about how they get their funding, well, it's still kind of a mystery. Our job today is to start cracking that code.
All right, so let's start where you'd expect, with the most logical, straightforward solution you'd find in any finance textbook. It's called the static trade-off theory.
Okay, so at its most basic level, a company really only has two ways to raise cash. There's debt financing, which is just borrowing money, and there's equity financing, which means selling ownership stakes. A good way to think about it is like buying a house. Debt is your mortgage, and equity is your down payment. Now, debt looks pretty good. It's usually cheaper, and the interest payments are a tax write-off. But you absolutely need that equity, that down payment, to provide some security and a safety buffer for when things get tough. And this balancing act is the heart of that static trade-off theory. The whole idea is that a company's managers are kind of like scientists, trying to find that one perfect optimal mix of debt and equity. They keep adding debt to get those nice tax benefits, but they stop right at the point where the risk of going bankrupt starts to outweigh those perks. The goal, the holy grail, is to find that one magic ratio that makes the company worth as much as it possibly can be. So how in the world do they find this sweet spot? Well, the main tool for the job is something called the weighted average cost of capital, or WAAC for short. Just think of it as the average interest rate a company pays for all of its financing, blending together the cost of its equity and the after-tax cost of its debt. According to this textbook theory, the mission is simple. Find the exact mix of debt and equity that gets this overall cost of capital as low as it can possibly go. But of course, before you even start worrying about how to pay for something, you've got to decide if it's even worth doing in the first place. And that's the job of this formula right here, net present value, or NPV. It's this really powerful tool that answers one simple question: is this project actually going to make us money? It works by taking all the cash the project will spit out in the future and crunching it down to figure out what that's all worth in today's dollars. If that number, the NPV, is positive, it's a green light. The project is a go, and the capital structure puzzle officially begins. So, the textbook answer seems to lean pretty heavily on using debt, mostly because of those tax breaks. This strategy of using borrowed money to pump up your returns is called leverage, and it is an incredibly powerful tool, but it's also truly a double-edged sword. Let's actually look at the math to see exactly how this works. This formula here calculates return on equity, or ROE. That's the profit shareholders get for every dollar they've invested. You can see it starts with the basic return on assets, or ROA. But then it adds this extra kick from leverage. See this part of the formula? What it's really saying is that as long as your company is earning more on its assets than it's paying in interest on its debt, then adding more debt, cranking up that debt-to-equity ratio, is going to magnify the returns for your shareholders. Let's make this real with a quick example. Imagine a company that earns a solid 10% return on its assets. Now, if it's funded entirely with equity, the shareholders get that 10% return. Pretty simple. But now, just look what happens when it's funded with a mix of debt and equity. That same 10% return on assets gets supercharged, all the way up to a 19% return on equity for the shareholders. They are literally making a profit on money they borrowed. That right there is the magic of leverage. And here you can see that double-edged sword in action, plain as day. On the left, that's the upside. When the business is humming along and its return on assets goes up, the ROE for shareholders just skyrockets. But on the right, you see the danger. If the business starts to struggle and its ROA drops, that same leverage works in reverse, and shareholder returns absolutely plummet just as fast. Okay, so the textbook answer seems pretty straightforward, right? You rationally calculate your perfect capital structure by trading off tax benefits and risk. Find that perfect balance. But when we actually look at what real companies do in the real world, the picture gets a whole lot messier, and honestly, a lot more interesting. And this brings us to a totally different theory, one that's a bit more cynical, a little more street smart, and, well, maybe a lot more realistic. It's called the pecking order theory. What the pecking order theory says is that in practice, managers are not constantly fine-tuning their debt-to-equity ratio to hit some magical target.
No, instead, they have a preferred order for raising money, a hierarchy they follow almost every single time. And their actual debt ratio is just the leftover result of these choices piling up over time.
And here is that pecking order. It's incredibly simple, almost common sense. First, companies always prefer to use the money they've already got, their internal cash. It's the cheapest, it's the easiest, no questions asked. If they need more, then they'll go to the outside world, but they'll issue the safest thing first, debt. And only when they've basically run out of their ability to borrow as an absolute last resort will they issue new stock.
But why this specific order? I mean, why not the other way around? Well, the answer lies in a really important concept called asymmetric information. Now, that's a fancy term for a very simple idea. The managers inside a company know way more about its true health and its future prospects than we, the outside investors, ever could. And the financing choices they make, they send powerful signals to the rest of us.
I mean, think about it from an investor's point of view. If a company suddenly announces it's selling a bunch of new stock, your very first question should be, why now? If the managers, the people with all the inside information, think that right now is a good time to sell ownership in their company, it might be a signal that they think the stock is currently overvalued. Investors get worried they're being sold a lemon, and that fear is exactly why issuing equity is the absolute last resort in the pecking order.
So now we've got two competing theories on the table: the rational calculating static trade-off model and the behavioral signal-based pecking order model. So which one does a better job of explaining what happens in the real world? Well, let's look at the evidence.
Well, the evidence from the real world really seems to line up with the pecking order theory. We see that when companies announce a new stock issue, the price usually falls, and when they announce a stock buyback, the price tends to rise. We also see that riskier firms, like tech companies with lots of intangible assets, tend to borrow less, and that makes perfect sense, right? It's a lot harder for a bank to value a bunch of code than a physical factory, which increases that information gap and makes debt financing a lot trickier.
So, it seems like the pecking order has the edge. Myers actually concludes with what he calls a modified pecking order story, and this suggests that firms aren't just blindly following these steps, they're strategically managing the process. They intentionally limit their borrowing to maintain what he calls financial slack, basically keeping some borrowing power in reserve. This gives them flexibility, so they're never backed into a corner where they have to sell off stock for cheap, or even worse, pass up a fantastic investment opportunity.
And that leaves us with a final, really practical question to chew on. The next time you see a headline that a company is raising money by selling new shares, should your first reaction be excitement about all the great new projects they're going to fund? Or, knowing what we know now about the pecking order, should you be just a little bit worried and start to wonder what the insiders might know that you don't? Definitely something to think about.